March Madness, who is winning and who is losing? This is San Diego real estate market update for March. So I assume we have to pick the 4 winners. My name is Lenska. I'm with Lenska Realty. I'm an investor and also real estate broker, and I'm giving you the latest market stats and hope that will help you decide what to buy and what to sell and will increase your bottom line. And don't forget, please subscribe to the channel so you get the latest updates. What are we looking at when we analyze a real estate market? So we look at the sales and inventory numbers, interest rates, employment data, the HPSI by Fannie Mae, which is a kind of a house sentiment, and home builder sentiment, eviction foreclosures, forbearance. So let's get started with the sales and inventory numbers, how we ended up in February. February started strong. The median home price rose $25,000 to $30,000 just in 1 month. It is right now at $670,000, up 14.8%. The median home price for detached is $775,000, which is also up 14.8%. And for the attached units, we're looking at $511,000 and up 14.3%. By the way, the average home price for detached actually is right now over $1 million. So, which means the average price per square foot in San Diego currently is $472. The market is still moving obviously very fast. If it's not sold within the first weekend, there is something wrong, or how we real estate agents say, we have the home listed for 5 minutes, and what's wrong with my property? I don't have 20 offers yet. So pending sales are up 8%, which we compare to our starting of the COVID crisis last February, right? So we're still up, and the sold listings are about 1,575, which is slightly up 5%. And the sold listings for attached are up 10.5%. Leveled off. Remember last year I said to you the median home price didn't go anywhere over 650, 645, and then now in January and February we have seen that going up, straight up. And that's kind of how it played out last year. So we had about, as you can see, we had 656, 650, 645, and all between August and January, okay, of this year. And then February and March, so this is as of March 4th, and actually right of this minute of the recording, we are currently at 675,000. And this is, who is the big winner? The homeowners that actually own real estate. They gained more than 1.5 trillion in equity in 2020. Who is not so excited about that? Obviously investors, because we're always hoping for a deal, and only 1.5 million homes, representing 2.8% of all mortgage properties, have negative equity. So which means if they would sell that house, it would be a short sale, which we have seen back in the big financial crisis. And here's the reason why we see that sharp increase in home prices. Inventory of homes, we have 27 days, and new listings are down 18%. So as you guys can see, at about the spring of 2019, was able to finance, because if you can finance for 3%, we have inflation for 3%, real estate is one of the best hedges. So who are the winners? Anybody who actually was able to buy a property. And by the way, if you like this, what you hear so far, please hit the like button and even the subscribe button. So the average, and here's another reason why we see the market is hot, hot, hot. We have never seen a 100% or over 100% average close price to the original list price. So in 2013, we came close. Even in 2005, which we thought, 2004-5, which we thought was the hottest market, it dwarfs what is going on right now. How are we looking with mortgage interest rates right now? The 30-year interest rates actually climbed above 3% the last few months. And note the disconnect between the weekly Treasury 10-year in red and Freddie Mac's weekly measure of the average 30-year fixed mortgage rate in blue. And that too appears to be a little smiled upon by the Fed, but they're not blind. They see that what's going on in the housing market. So, and they know that the risk is piling up with this type of housing price inflation. I know nobody wants to talk about inflation, but I think this is a type of inflation, and they just can't say it out loud. But they can let long-term yields rise, and usually then mortgage rates have to do some catching up. Now we're going to go right into the employment data. You guys know that's my favorite subject. And as always, we actually have seen a slight improvement, which means a 6.2% last year. Last month, I think it was 6.5. That is the published rate. I call it the political employment rate, but what we are looking and what you should be looking at as the U6 employment, which is the total unemployed plus all marginally attached workers plus total employed part-time for economic reasons. I probably would add a few million people to who have lost a lot of their income but maybe don't show as unemployed, because we had a lot of like gig workers or even as real estate agents. You guys saw that we only sold about what, 2,400 units last month. Well, we have 15,000 agents. So, even I think all the positions at Starbucks part-time work for real estate agents are probably filled by now. So we still have a stubbornly 11.1. Even so, we added some employment non-farm payroll in February, and we'll see if that will continue in March. Obviously, it all depends on the reopening, and there will be a lot of people rehired in the service and leisure and hospitality. So this is what I'm concerned about. I'm concerned about the long-term unemployment, because this is right here, what is the average length of the unemployment? And so that chart kind of illustrates we're perhaps seeing a little bit of a paradigm shift, kind of the result of global outsourcing and also efficiencies of technology. And that we also have not the right talent for the jobs that are available. So the duration of unemployment as of January 2020 is at about 27.6 weeks. Well, of the 40.7 week all-time high in late 2011. But this number is still currently on an uptrend. And here at our America's finest city in San Diego in March, unemployment rate is 5.14, and it was last month's 8.9. So we certainly see a huge improvement there. And with all the stimulus we had, and we talked about it, how people are seeing the personal saving rate. So it was when the CARES Act came out the first time, it was the savings rate shot up to 33%. Yes, all right, we couldn't go to the movies, we couldn't go out, we couldn't go shopping, But on the other hand, a lot of people put that money into the stock market, which we see, and also into their homes and improvements and pools, new kitchens, new appliances, since they seem to be hard to come by right now. So again, over this last weekend, the Senate passed that 1.9 trillion disaster relief package, which was voted in, and also the $1,400 checks will be sent out, and the 6 months of pandemic unemployment insurance, rental assistance, and many other more relief items. So that cash will have to go somewhere. What do people think and feel about the housing market right now? Fannie Mae comes out and says, what is it a good time to buy? Is it a good time to sell? What do you think home prices will go up? Will mortgage rates go up or down? And are you more confident of keeping your job? And how was your household income compared to the last 12 months? Let's see how people felt about it. So we lost another 1.2 points in February, and practically reversing last month's increase. And notably, the 4 out of the 6 HPSI's components fell month over month. So we had a negative outlook towards buying conditions, because we have, offers, multiple offers, and people are bidding up the properties between $5,000 and $50,000. And also, people didn't feel they made more money this year. So how are we going to pay for all this higher housing if our household income is not catching up? So we see that inflation and higher prices everywhere, but the income is not catching up. But the optimism was definitely there of people don't think that they will lose their job. So we kind of have a sweet and sour look at that. So the jobs are back, people are winning with that, and but so are the pay cuts. It looks like buyer optimism falls and interest rates are rising. Evictions, foreclosures, forbearance. We still have 2.69 million or 5.1% of homeowners in forbearance. And you guys can see that, FHA has the highest percentage of share of loans in forbearance. And remember, FHA and VA, those are the ones with only the 3.5% or zero down. But right now we're leveling off. We don't see a lot of people getting out of the forbearance plans. And also part of it is, I believe, the misunderstanding of what forbearance actually was and how the lenders were supposed to help and not make people refi at a higher interest rate. So this is the one chart, to maybe that we will see some distressed inventory. The 90-day defaults are up 250%. So still foreclosure starts at record low because everything is bottled up in those defaults, as we still have a foreclosure moratorium, right? So this is probably the largest concern, and it's the largest number since 2009, where the activity peaked during the Great Recession. Just a little tip for landlords. I want you to be the winners, and just a note that accepting partial rent payments, a ruling showed that this might be a mistake, as by accepting anything other than the terms agreed upon in an initial rental agreement, you run the risk of inadvertently renegotiating and subsequently creating a new agreement. So make sure you document everything with your tenant that this is maybe for past due, or also make sure that you follow the housing eviction moratorium guidelines still in effect until June 30th. And there are tenant protection provisions in effect through June 30th. And there is this great rental assistance program out for landlords. And if you're a member of SDCIA, you can apply for these emergent rental assistance funds. And for California, we have it right here. It's the bcsh.ca.gov/CO or COVID relief. And you can find that on their website. And who was the winner and loser when it comes to San Diego? When it comes to migration, it was certainly San Diego was kind of in the middle, but the big winners and where you see a big appreciation going on is Phoenix, Las Vegas, Salt Lake City, the Texas market, and Charlotte, Raleigh, and Atlanta. Surprisingly, actually, Florida was more or less in the middle, and no surprise that San Francisco also was kind of in the middle. Home builders are definitely the big winners. They're selling their single family houses fast, and the all regions sentiment was 84, but in the West it was about 90%, which is still down from the peak in November of 2020. Why? Home builders love it, knock on wood, that the new home sales stay up 20%. We had an increase of 4.3% from January to from December to January, and it was nearly up the 20% from a year ago. And not only were the sales up, also where the home prices for a new home right now is about $408,000. But not so fast. There's a little losing streak in there too, because the lumber prices just shot up about 200% in the last year. But hopefully how John Burns has a really great podcast and stuff. So they were hoping that the booming residential markets will still have a little bit in a demand shock, and it will take the industry to ramp up the production, and hopefully we'll see a little bit of going back to normal. That said, since new homes are selling like crazy, we don't have existing homes, so there's a strong demand for land for recreational and residential. Not to say here in San Diego with Amazon expanding, there is a huge push towards the commercial market and land as well, especially down in Otay Mesa. So here for you investors, maybe to look in that market because people will need to have housing down there. Which means capital is looking for returns in the build-to-rent market. So fueling the affordability crisis, Fannie Mae will probably, and governments or cities will be looking to focus on lower income properties. Also, it is very good now to convert from hotels into, or convert hotels into apartments, and especially more in the Midwest where the stringent building codes are not as in effect as here in California. You find that smaller motels and stuff can be easily converted into efficiency units. And obviously my favorite, the upzoning, which means that we can put ADUs on single family homes and also multifamily units. And you know, it's all going around the tiny houses if they're being permitted, and infills, and also co-living as a investment. So what's the recap for our March madness? we have a lean and mean spring real estate market. Buyers are the losers, sellers are definitely winning. The interest rates are ticking up, which could cool the housing market. So the housing market could maybe get back to, I don't think to normal this year. Unfortunately, we see still a lot of unemployment in the leisure hospitality industry. Especially it will spill over to the business owners and restaurant owners. And if you have seen how many retail shops have closed, so there definitely are some of the losers. And we also might include some landlords, because will trillions be enough to help landlords? The median home price is up, so it's really the fittest only the fittest buyers will get a house. Inventory are extreme low levels, which means losers are real estate professionals, especially agents. The commissions are down to 2% for buyers, and it is very hard for investors to find a good fix and flip deal, and also to find good investment properties here in San Diego. But we are very close markets close by that are still you still can find deals. And wait, there is more. If you liked what you heard, please subscribe. And if you have the thirst of learning more, every month for about the last 12 years, I teach a class, Real Estate Investing Field Trip, which we showcase real estate investments. And this time we will be talking about ADUs, and might be talking about ADUs for a while. That is really your best increase of ROI. Thank you for listening. Please subscribe. And as always, I'm here for your questions to help you increase your bottom line and be a winner in 2021.